The ultimate promise of real estate investing is the ability to buy a rental property, pull almost all your original money back out of it, and then do it all over again with those exact same dollars. For years, regular investors used this process to scale their portfolios without needing a mountain of cash. It's called the BRRRR method: buy, rehab, rent, refinance, and repeat. But the market landscape in 2026 is entirely different than it was a few years ago. Interest rates are higher, inventory is tighter, and lenders have raised their standards. After running the numbers, the math still works. The strategy is absolutely viable today, but only if you are willing to trade loose estimations for strict mathematical discipline. Step 1 is to buy a distressed property below market value. You are specifically looking for a property priced below what it will be worth after you fix it up. That future price is your after repair value, or ARV. Every decision you make is built around this single number. Your initial purchase price, plus expected rehab costs, must not exceed 70 to 75% of the after repair value. If a property appraises for $200,000 renovated, your maximum all-in cost stays under $150,000. This map shows where those margins actually exist right now. Finding a 75% discount in a hot coastal city is incredibly difficult in 2026. The active opportunity zones for this strategy are concentrated in the Midwest and Southeast. To find these off-market deals, investors use digital sourcing tools like PropStream. By filtering public data for absentee owners, pre-foreclosures, and properties with high equity, you can locate highly motivated sellers. Overestimating your ARV or overpaying upfront breaks the margins for every subsequent step. You secure your profit the moment you buy the property. Step 2 is to renovate the property. This is a strategic rehab, fixing what affects value: the roof and HVAC, plumbing and electrical, kitchens and bathrooms. Material and labor costs remain elevated in 2026. Relying on outdated rehab estimates from 2019 leads to a severe capital shortfall before you finish. To lock in your true cost, require 3 separate contractor quotes before you close on the property. This spreadsheet shows how a modern budget is structured. Notice the bolded row at the bottom. You must mandate a 15 to 20% contingency fund in every single rehab budget you build. Surprises during renovations are inevitable, and this buffer absorbs them. The goal of the rehab is to get the property to a condition where a bank will appraise it at your target ARV. It is a mathematical exercise, not a personal interior design project. Step 3 is placing a tenant. Before a bank lets you refinance, they want proof that the property generates income. That means screening a tenant carefully and documenting at least 1 to 2 months of solid rental history. This diagram shows the 1% rule. Your monthly rent must be at least 1% of the total property value to comfortably cover the new mortgage. On a $150,000 property, you need a minimum of $1,500 monthly rental income. Vacancy rates are low, and rents have held up across most metros in 2026. As long as you avoid overpriced, low-yield markets, the current rental demand actively works in your favor. Securing reliable, documented rental income creates a financial shield. It proves the property pays, allowing you to surpass ARV. A lender typically offers a new loan at 75%. That $150,000 loan pays off your $140,000 your original capital plus $10,000 back in your pocket. But here is the primary failure point in 2026. With interest rates higher than they used to be, your new mortgage payment can easily wipe out your rental income. This interface is from DealCheck. You enter your expected rent, your rehab costs, and current refinance rates before you buy. You need to verify a positive monthly flow of at least $200 to $300 per unit. Successfully extracting your capital means nothing if the resulting debt turns the property into a monthly liability. Step 5 is repeat. Because you pulled your original capital back out during the refinance, you are fully equipped to start step 1 all over again without having to save up a brand new down payment. The second cycle moves noticeably faster. You now possess a proven contractor team, reliable lender relationships, and a process you can replicate. This timeline illustrates the compounding effect. By reusing the exact same dollars, an investor can realistically scale from a single property to a 5-property portfolio in under 4 years. BRRRR is a revolving, operational system designed for exponential portfolio growth. So, does the strategy survive the current landscape? Yes. The BRRRR blueprint is mathematically sound in 2026, but the margin for error is significantly tighter. Surviving those tight margins requires strict adherence to the 75% ARV rule, heavily padded Rehab budgets, and carefully verified cash flow projections. If you are geographically restricted to non-viable coastal markets, look at platforms like Roofstock. You can use it to browse vetted investment properties and execute these deals remotely in the Midwest or Southeast. Success in the current real estate market belongs exclusively to the disciplined investor who trusts cold data over emotion. You can find links to all the digital tools I mentioned in the description below. Drop a comment to let me know which of the 5 steps you want broken down next, and subscribe for a new real estate strategy